whether there's enough momentum in earnings so far to keep this rally intact. Let's ask Professor Jeremy Siegel of the Wharton School. He is live with us once again. Professor, it's nice to see you again.
Good afternoon, Scott.
We heading towards new highs, Professor?
I think so. I mean, this is such a strong market. You hear the guidance from the firms that was so tentative. In the first and second quarter, a lot of it is so much more confidence. The internals are improving. It's broadening out. The ECI, that employment cost measure that Chairman Powell mentioned a couple days ago came in below expectations, as well as the others. Goldilocks, lower inflation and stronger economy and good guidance and good profits. What's to stop this market now?
I don't know. Jay Powell and company, maybe. You think they're done?
I'm not sure that they're done, but what I'm pleased about is that he acknowledges that there are two-sided risks, that he's going to, every meeting is a live meeting. There's no preconceived motion about whether they're going to go up or down. They're going to look at the data, which is something that, I've urged for quite a while. Frankly, as you know, when I saw the money supply go down, decelerate by the greatest amount in history, I was concerned. I was worried about what was going to become of the economy in the second half. And I'll tell you, the first half, I don't know anyone who thought that the first half would grow faster than 2%. I would look back in my records, even the Fed was way below that in its estimate. So inflation coming down, stronger economy, I don't see this stopping anytime soon.
Do you think that the Fed is looking at the right thing? I mean, there are some who suggest that they're fixated on lagging indicators and not enough on what's actually taking place on the inflation front. The danger, of course, being that they end up going too far as a result. Do you share those concerns?
Well, I did a lot earlier on. I still have trouble with this year over year because it's 11 months of old data and then 1 month of the new data. And we all know how lagged the housing indicator, which was, still recording increases every month, even though it's gone down year over year. But I think now the Fed gets that. And they realize that there are a lot of lags in that system and that they have to look at that forward-looking indicator. So I'm less worried about that now than I was 3 or even 6 months ago.
The bears would say, and we're going to talk to one in a minute, by the way, and we're going to have a debate.
Okay.
But they would say that, the bulls will come up with any excuse to justify valuations which are stretched. They're stretched far past historical averages. And given the environment we're in, where earnings are still not great, better than feared isn't good enough to justify valuations here. How would you respond to that?
Well, the S&P is selling about 20 times next 12 months. My research shows that that's about average. I mean, the tech stocks are 30. The value stocks, the cyclical stocks, so fearful of that inflation are 14, 15, 16. That's extremely reasonable. So, you could argue that the tech stocks may be a little bit over their skis in terms of how far they've gone. I would prefer the value stocks on the long run. But when I look at this market as a whole, I do not see any significant overvaluation. I think back in the dot-com bubble where the S&P was selling over 30 times earnings in a much higher interest rate environment than we have today. That was scary. I don't regard today's valuations as scary.